So, so as you rightly said, we focus too much on the economic and the business cycle, but we forget the market cycle. And that HUL example was very, very, very interesting. So I'll probably go deeper into this segment now. So we have a couple of questions on the chat box also, which I think I can take now. So Samved asked that how are you able to buy during pessimistic time during the bottom of the cycle? And can you share some specific name of sectors where you had to wait 5 to 7 years for waiting for the turning up of that sector? And what would you uh, uh, guide or advise to investors how to look at them?
Yeah, so as I shared, previously, long time back, I think steel cycle when I invested in the, what, 2007 or something, 6 or 7, I had to wait for 7 8 years for things to turn around. Uh, so one stock which was a multi-bagger for us uh, in this cycle in steel, okay, that stock I had held previously in the past cycle for 5 6 years with no returns, and actually sold out after 5 6 years at probably the price I had bought. But this same stock post 2015, when there was a contra cyclical, and we could anticipate that this cycle will turn now. This thing, because of studies of past cycles and so on, this particular stock again gave us, I think 20x returns. Okay, so if you are able to understand this, uh, you can basically make tremendous returns. Uh, but the thing is, in the first instance, I was not understanding it, and I bought it for maybe during when the steel cycle was doing well, and this company was churning out good profits and so on. But then bad cycle hit, and this company was almost on the verge of bankruptcy, and so on. So the idea is, so when do you buy? So as I said, there could be two ways to buy it in cyclicals, which one is contra cyclicals. So this company in the second inning, we bought it when at peak pessimism. Okay, but see, the thing is that we are evaluating a lot more things now, or we learned a lot more things. So I could understand that lot of supply is going out. So this you know these particular times will not last a long for long. So 2015 is when we started investing in this company. Uh, it was 200 crore market cap company, very small company. Me and Nitin, we started investing in this company at height of peak pessimism. And I'll tell you particular instance where complete contra thinking works. Because when we were researching this company, we were talking to a lot of people on the ground on steel, what is happening, and so one steel management we talked to said, अरे यार सर आप क्या देख रहे हो स्टील में, हमारे पास तो जहर खाने के पैसे नहीं है. Okay, so that is something where if you could assess that, okay, this company will survive for some more time, uh, that is probably, I've seen that one of the best times to buy, when even the managements are overly negative. Okay, so what happens is that is a time when a lot of supply goes out, and you can verify that with what is happening over the globe and over different companies. A lot of players were closing down. So once the see again, cyclicals is basically understanding demand and supply. So if supply is going out and that there is demand, right? There will be demand. It could be 5%, it could be 10%. That's a different thing. But if supply is going down and a situation comes where demand is higher than supply, prices will go up. So so you have to just wait for that. And believe me, it was a fantastic journey this time around for us in steel. Same thing, sugar. Sugar also. Uh, I bought on certain triggers, failed monsoon and Brazil crop failure. Okay, 2015. Uh, and this time I was a lot more prepared because I studied previous cycles and all. So triggers were clearly available that there will be reduced output of sugar. Sugar production will be lower because there is failed monsoon in India, and another big supplier is Brazil, and Brazil also had a failure. So it's a situation where if you understand cycles, and if you have basically done your work, that when supply will be short, then prices will rise. Okay, demand you already know. Okay, uh, and it works so fantastically well that I bought a basket of sugar stocks uh, during that point in time, and I think over the next 18 months the whole basket gave me an average 7x return. Okay, and there also, see, the thing is, and I sold when things were the best. They were churning out the best profits. Okay, even in steel also it happened. We sold when they were generating the best profits. uh, the thing is, you have to understand that this profit will not be sustainable. Of course, you can't be exactly right. You can't time the top, but as long as you have certain parameters for exit, uh, then you stick to that. For sugar, I had did the study of past cycles and all that. I looked at uh, the the minimum prices, the lows and the highs, and I of course worked that in Excel and all that. And over the whole sugar basket, the returns in past cycle were 5x to 9x. Okay, so that data you had. So then you devise a strategy. I said, average of that is 7x. 7x पे अपन निकल जाएंगे. Okay, so lot of stocks I sold. They still doubled after I sold also. But I got my 7x. Okay, I had a strategy in place. I got that. Okay, over the years, I uh, tried to develop where if this is going to 11x, see how much I can go from 7x to that journey of 11x. How much I exit at 10x? You can't expect to exit at 11x, but can I exit at 10x or 9x or something? So that strategy is obviously I've been developing and sharing and so on. But the thing is, you should have a strategy in place when you're playing cyclicals. For steel also, it was basically the fact that these kind of margins, and I've said that in interviews, that for example, margins of 38,000 rupees per ton are not sustainable. Okay, you have to understand that. Now when to exit is something, because market is also smart. Okay, you think के best result आने के बाद में मैं exit करूंगा और उसके बाद खराब, वैसा होता नहीं है, because market also has a mind of its own. Market also is forward looking. So people start discounting all these things. तो उनके discounting करने के पहले अपन निकलना है, is what I'm trying to do. Okay, so usme there will be obviously something which you leave on the table, which is fine as long as you have made your return. So number of strategies are there. For example, I said, as I've always said, P is the worst metric to look at when you're playing these festivals. There are so many other better parameters, uh, like replacement cost or price to book. In bad cycles, you get assets at 20% of replacement cost, 25% of replacement cost. When these things happen, that is when, if you can ascertain that this company will survive, let's say, so we have kept a very simple check, a stress test sort of, that if this company can survive another 2 years of downturn, because understanding cycles and understanding demand, supply, and all that, that these times cannot last for more than 2 years, such bad times. If that, then there will be something which will seriously go wrong. Okay, and if it is a commodity or cycle which there is no disruption, in the sense that steel you will need, right? There is no alternative to steel, or sugar you will need. I mean, unless there is a situation where everybody stops eating sugar or there is a significant thing, and that data also will be available to you through studies and all that, right? So that yes, sugar, demand growth may slow down, but it is not going to reverse, right? So that, if you know that, and that supply is going out or supply is going to go out more, you can position yourself in such a way. So then you look at price to book or replacement cost and so on. So for example, steel, you can have you buy at 0.3, 0.4x of replacement cost, and or price to book rather, and sell at 1.2 to 1.4. In that cycle, when we exited, stocks were valued at more than 2 times price to book. It has actually overshot than what we had thought, but we were kind of, and that's why I said, we are also devising strategies how to this thing. But at certain point in time, you have to say enough is enough. So at 2x plus book value, we said, okay, now we need to basically. And also what happens is that you also keep on evaluating risk reward at any point in time. At 2x price to book, your risk reward is not in favor. Uh, there could be other cycles where you are getting at, you know, point 0.3, point 0.4 replacement cost or price to book, and you have a better chance of generating returns there. So you just exit from here and move to uh, uh, these particular sectors and so on. So always there will be, you know, you always have obviously limited capital. uh, if you are advising, then you have uh, only that many number of stocks you can advise, right? In your list. So let's say we run a 20 stock this thing. So even if I like something and I still think that there could be, you know, another 30% price rise here, but if I find something where I believe that, you know, I will get a 60% price rise and that, you know, this reward is in favor, I might switch. So these kind of decisions, as a fund manager or as a research analyst, you have to take. As an investor, you have to take. Again, a lot of factors go into evaluating when to exit and when to enter and so on.